If you're liking the cyclical play in Japan, what's the risk of the numerous states of emergency that we've seen in Japan actually pressuring that?
Yes, it is true. It is testing also our patience to some degree. But I mean, inevitably, right, we're heading towards 50%. We're going to surpass that. So in terms of vaccination, that is on track. So yeah, the reopening apparently gets a bit delayed, happens later than we initially thought, but it doesn't lead us to take it off because it is bound to happen eventually. The other interesting driver also for the Japanese market, I would like to mention then is, we analyzed a bit which of the markets globally are actually most sensitive to the 10-year, which we expect to move up. And perhaps not surprisingly, it is also Japan, so it's also probably the financials, etc. So they actually have probably a couple of drivers for the rest of the year for Japan to really come back and start to outperform, at least from here.
With Jackson Hole now in play, what are your expectations in the short term for those financials in Japan, not to mention the 10-year?
Yeah, they're very linked. In fact, many financials around the world are linked to the 10-year. Probably not so much fireworks out of Jackson Hole. I know everybody remembers still 2013 perhaps, and that was of course fireworks. But otherwise, we think much more likely that the Fed goes back to its regular meeting, so probably the September meeting, to talk about this a little bit more. But nonetheless, it is happening. Therefore, also by the way, in terms of steepness of the yield curve, it would be the first time that the curve is this flat when the Fed really exits. So another reason to believe that we could see a bit of upside on the 10-year. And if that happens, of course, that is bullish for banks in particular, but financials more generally speaking.
Hartmut, how much more upside is there when it comes to the recovery in tech? Because clearly we've seen that reopening trade really get abandoned, right? Are there better opportunities given the valuations that we continue to see in tech?
Yeah, tech, especially large tech, we think that to some extent, at least tactically, they sort of had their day in the sun. No, not that we're necessarily negative, but we certainly encourage our investors to be a bit braver and don't see the reopening or the reflation really as only a trade that can only last a few months. If that was the case, we may have already seen it, but we do think there is another leg. And also as we speak for the big tech, right, they come in with a very high base on earnings now, and that is not that the earnings are collapsing or even growth is going to negative, but the growth rate is also slowing. So you have actually a good mix to really broaden out the portfolio beyond what many of the investors have done in the last couple of quarters.
Will materials and energy companies continue to outperform if we see the sustained demand for commodities?
And we think on the commodity side, especially energy could be an interesting trade. And I think the more straightforward, obvious side to it is the final leg that we need. So the opening of international flights that in terms of demand would bring us back then to pretty much the pre-COVID levels. And one thing I also think about often is, and that it doesn't get as widely discussed usually, is the capital discipline that especially the oil majors have shown since 2014, basically. I mean, their capex has halved, and interestingly and differently from previous cycles, their shareholders also don't want them to go back and now, even if the oil price is higher, go back and invest this in fossil fuel anymore. Right? So you have a bit of a also structural game changer in terms of the capacity that's available. So I think counting these two together, yeah, energy should be another trade that should work well.